Hello, everybody. Welcome to our panel today on risk management and artificial intelligence and machine learning. I want to start today by introducing myself. My name is Melissa McGregor, and I'm a Managing Director and Associate General Counsel at SIFMA, the Securities Industry Financial Markets Association. I'm based in Washington, D.C., although obviously currently based in my home. We look forward today to today's panel. I'm going to ask each of the panelists to introduce themselves. We're going to start with Aoife. Aoife May, would you introduce yourself?
Sure, thanks, Melissa. Hi, everybody. My name is Aoife May. I'm part of the Wolters Kluwer GRC team. So I work in a division known as Compliance Solutions. And within Wolters Kluwer, I'm a senior pre-sales consultant. Typically split my time between Dublin and London, but working from home right now too. So in Ireland, and yeah, looking forward to discussing today. I have some experience with advancing technologies, with regulatory information, and also implementing those solutions. So looking forward to our panel.
Great. Let's go next to Kaivalya.
Hi everybody. My name is Kaivalya Vishnu. I work for Bank of America. I'm based in London, and I'm part of corporate treasury technology, and I've been managing a number of regulatory implementations for their corporate treasury. And I'm looking forward to this very interesting discussion today. And as I've been managing a number of regulatory programs.
Thank you. Next, Brian Clark.
Hi, good morning and good afternoon, everyone. Brian Clark, I'm the CEO at Ascent. I have a background as counsel and the chief compliance officer, and also as a regulator. So I've sat on both sides of the aisle. Looking forward to the conversation today.
And last, Jeff Simmons.
Hi everyone. So my name is Jeff Simmons. I'm the Chief Risk Officer and the Chief Operating Officer of of MUFG's Brexit entity set up in Amsterdam with a branch in Paris. I've been in, risk for since dinosaurs last ruled the earth, and so I've been in both on the IT side. I've worked in regulatory change, and now I'm on the risk and operational aspects. So it's going to be interesting to see what technology can offer as we go forward.
Great, and I don't think that you could have a much more global panel than the panel that we currently have right now. So thank you very much, everybody. So let's get to our panel today. So let's start with you, Jeff. How do you see the role of the chief risk officer evolving in light of technology and AI, machine learning, RegTech generally?
So I guess I kind of see the question in three parts, which you just mentioned. You've got technology, you've got AI, and then I think that the third part really is the role itself. And so if I start with the role and then see how technology and AI can help. Right? So I see the risk management as a function was born as a child of finance. This was when 20, 30 years ago, we had a breakaway of the risk and treasury functions, if you like, into a risk management type of world. Risk management became more and more quantitative, and so risk and finance moved away and went their own separate and independent routes. Now, with things like ICAP and stress testing and other business modeling tools, then risk and finance are starting to come back together. The EBA stress test, the PRA, the CCAR are all about stressing business plans, which is a combination of risk and finance. So I kind of see the CRO becoming part CFO as well. Then on the technology side, I think the technology will, and I'm sorry, this is a bit of a cliche, but give the CRO the opportunity to see the risks at the top of the house and be able to work with the business in being able to support and challenge the businesses in making money. And then how does AI help? I actually, I'm very excited about where AI is going, and And this is going to work for both of these two categories, the role and technology. Because what AI should be able to do is help the CRO and management generally in being able to find risks that they don't know about. All right, and that's the challenge of a chief risk officer. Is it's not about what ends up on your reports or what analyses or stresses you ask for. It's the ones that you don't ask for that you get caught by. And I think AI can help identify that by coming up with essentially scenarios or situations that perhaps a human being wouldn't have thought of. And so that's kind of where I see the chief risk officer going. Combination of risk and finance. Technology to support them at the top of the house in being able to support and challenge the business and identify known risks. AI coming along beside it, being able to support the chief risk officer in being able to identify risks that perhaps are not easily identified or being thought of. So I'm not sure if that answers your question, but that's kind of my statement. Kaivalya, you're going to jump in and tell me I'm all wrong?
Anyone else? Brian, do you have anything else to add on that point?
Yeah, I agree with a great deal of what Jeff is saying, and my apologies for the Chicago lighting in the fall here. We're having the sun come in and out of the clouds. So I agree with pretty much everything Jeff said. I think the way I've defined it, and this is a bit from the compliance and regulatory side, is I always look at risk as the new operations. So I think it's interesting that there's this quantification that you were discussing. And that's really the key, is things that used to be a bit more intangible, a little bit more, I guess, traditionally risk-based, and that they were qualitative, are becoming very quantitative. And we're seeing this happen in a variety of different areas. It's kind of the remainder sum. How do you capture that remainder sum that can impact the trajectory of a business? How do you capture that risk? How do you measure it, mitigate it, et cetera? As other roles are kind of inward facing outward, we look a lot at risk objectives of how do you manage the outward that faces inwards. And I hear about a new risk category on a regular basis, financial, credit, market, regulatory, compliance, non-financial. There's a new name every day. And so I'm certainly empathetic, Jeff, to the seat that you sit in to manage that. Where we look at quantifying this, to your point, we do it in three ways. How do you find those risks? How do you measure those risks? And then how do you mitigate them? Which sounds simplistic, but I think that where a lot of folks have fallen short before is finding the risks. And to your point on technology, it's really difficult to find those with high volumes of data in a lot of variant circumstances. And it's only by using technology can you actually determine what all of those are with much more certainty in order to then mitigate them. And that leads to my last point, which is the how. So it's, you've got risk evolving, you've got to be becoming more quantitative, but how do you do it? And what we're seeing, and what I'm seeing directly, is that it traditionally was a top-down approach, right? You'd have experts and people opine, provide ideas, thoughts. You can assemble a lot of different data sets from these behaviors and opinions. But what we're seeing instead is what I call a bottom-up approach, line by line, in whatever discipline you're in, to actually figure out the complete set of risks of every single item. And that still solves the problem, but it solves the problem with much more certainty, much more data-driven approach, and ultimately reduces the potential harm that could come to the firm if a risk is missed.
Thank you, Brian. And thank you, Jeff. So how are market factors such as changes in regulation and advances in technology having an impact on risk management? Aoife, do you want to start on the technology front?
Yeah, sure. And I actually, even just listening to Brian's last comment about that risk of not knowing, and I guess from a technology side, what we often see now is the shift to, so technology enables us to do so much more that it's kind of a cliche, but or the way of, you've got all of these really intelligent people working on your teams, but they're doing repetitive, mundane tasks of searching for content, searching for changes. And we often use a tongue-in-cheek term of use your degree and not your Excel skills. So this idea of technology enables you to acquire data. So when we think of like the umbrella term of artificial intelligence that we all love to just throw around and think that like what does it really mean? So when we think of like robotic process automation, like actually getting data. So each day, each week, whatever, each hour, checking a website, checking to see is there anything new. That that's not something that you need to have somebody on your team doing. So technology can really help you in doing that. But it can also a step forward, thinking of like natural language processing. Again, a term we hear thrown around all the time, but something like think of it as enriching data that you've got. So pulling out pieces of key information. So which part of the rule book does this impact? Which section of regulation might this enforcement action be against? Those kind of mundane tasks that we or like historically would have had people on our teams doing, all of that can now be automated. And I think we see a really big shift in the market for people wanting to automate these tasks. So it's reducing risk. It's the risk of not knowing a risk, but the risk of missing something. So if you think nobody misses MiFID, nobody hopefully hasn't heard of Brexit, nobody misses GDPR, but it's those smaller, it's that piece of guidance that was issued late on a Friday afternoon that you didn't notice on the regulator's website. It was the Q&A that was published that you didn't actually get ever analyze. It's those items that I think that they're the pieces where if you're receiving something like a data feed or if you're automating some of these processes, that you really start to see the benefits of these technologies. And it's time as well. So historically, any provider who was giving you a data feed was probably doing it manually as well, but was doing it for a large volume of people. Now with these technologies, the turnaround times, the SLAs that people can offer are so much shorter that it means that it makes sense for you to do this. And I also think from a risk reduction side, it's kind of historically people would have been thinking of it just gets in our tracker if we care about it. So we put this in, we're looking at it, we're kicking off a program. But what's also important is the idea of the items that may not impact you right now, but recording that decision. So it's the recording of decision making. So it's quite important as well. So you see, like technology is really advancing in this and quite quickly, thinking of like automated tagging of updates, tracking of items. I'm sure some of our audience are familiar with regulators who take pictures of documents and upload them on their websites, and all of a sudden you struggle with that. OCR can help with that. That can help you translate that or kind of get that into a piece where then your NLP can take control and figure out what is the regulator, what's the document type, what's this talking about. So as each year goes on and as we continue to evolve in this, I think the automation around this is quite important. I think manual tracking is decreasing constantly. And I think the volume of regulation, of course, so going back to the first part of the question, the volume of change is driving all of this as well. So, and I know, Brian, you have quite good insight into volumes of change and all of this, and I'll give you a chance to speak now too, but the volume is what drives this. So the large volumes of change, that the increase in scrutiny from regulators, the manual processes just aren't really seen as acceptable anymore. And I think, Brian, you had some input that we spoke briefly about on actual changes to the regulations.
Yeah, I think you bring up a great point. It's the change of the reg and the downstream impacts of those changes to the regulation. And I like what you were saying about these new technologies. They're cognitive tools that really help people eliminate that mundane kind of repetitive task, which I know you and I are going to talk about in the next question. But at the end of the day, you can use it to solve problems like, how does Brexit impact me, right? It's not just here's the data, you go through everything. And just as an example, we were able to do that on the line level for the FCA handbook to say, here's what that does to your firm based on your products and services. That's the level of granularity, and I know you folks do it too, that we can all get to with these new sorts of tools and technologies. They help solve the full end problem rather than just give you a dump of data.
Kaivalya, do you have anything to add on that?
Yeah, definitely. I think I agree with all the points that Aoife said or Brian said. And what I would say is that Aoife mentioned that the volume and the speed of the regulation that is coming in, that's quite enormous. And that's creating a lot of complex cross-functional challenges also. If you see, for example, the COREP is a cross-functional reporting regime where you have got about 40,000 unique data points. How do you ensure that you have got individual silos in your organization to manage capital, liquidity, and other credit risk and other platforms? Then when it comes to reporting, everything has to be integrated. Then you have to apply complex technology to navigate through this whole complex set of reporting or data points, make sure that they are unique. There are thousands of data validation rules that are put out by EMEA. And also then there are idiosyncratic dimension to it as well. You have got PRA's own regulatory regime. You have got in Asia Pacific, there are certain regulators which want the data and all the data capture to be onshore. So how do you integrate all that with the global firms to their books and records and in the system of records? How do you create the global system? How do you create the governance around it? That is going to be very important because it's a cross-functional and very complex data that we are dealing with. The volume of data is very enormous. So it's all a very governance driven, it all very complexity which adds to it. So these are all things that are impacting not just the technology itself, which is driving a lot of these changes, but the regulators have also become quite technology savvy. They have become quite sophisticated. Look at the way the data is being submitted to either it is a Fed in the United States or even EBA here. You have to create something called XBRL. I don't know how many, if you have dealt with that, Jeff, probably you might have heard about it, because you have to create that XBRL documentation, which is not possible without having the sophisticated technology reporting tools. And within that XBRL taxonomy, you have got, again, data validations, which you have to, again, implement certain piece of technology, whether you develop inside or you go to a vendor product. So it is all driving and having a big impact on even the risk management function, because risk management function is not just about the managing your business risk. It is a lot about the vendor risk. It has to do with data risk, data management, data governance, and then you have a people, process, technology governance around it. So governance and the complexity and the cross LOB synergies I see as another some interesting dimensions which are adding to it.
So you said something very interesting there. If I can just kind of put the comment back to you said that the regulators are becoming technology savvy, right? Yeah. And I think you're right. But do you think that they understand the consequences of the new regulations? I mean, you're absolutely right. Something like the COREP, right, which is grown from a relatively simple thing to very, very complex. Credit would be another example, which on the face of it is very simple but exceptionally complicated. Do you think the regulator understands the complexity within a bank on how to integrate all this, or is it just, if you like, a theoretical exercise?
I would hope that regulators they understand the complexity, because this is the constant challenge. You bring up a very interesting point, because regulators bring these changes to a regulation or roll out a new regulation, and the banks have to deal with it. One hopes that they have done their due diligence, but in reality, what we have seen that regulators themselves are evolving with the institutions. I think it is I think a very interesting conundrum here. Their technology is also evolving, the way they capture the data. from the institutions. What do they do with the data? And I've seen that the regulatory questions coming about a particular submission of the report few months later, because by the time they have captured the data and de-aggregated it and created their own metric, whatever they are monitoring, it takes time. So there, I think, on one hand, I would think that in terms of the regulation, they must have given certain due diligence, what kind of metric they are after. But at the same time, I would say that they are also evolving in terms of how the whole mechanism is going to work in reality, the kind of operational risk it is creating for the bank, and the kind of the I would say capital expenditure impact it is having on the bank, because all these things cannot be implemented overnight. It takes time, and it can only be implemented in a phased manner. So I think the whole process, I would say, I think there is a co-evolution that is happening within both regulators and financial institutions. And there's, I think, a fair degree of, I think, negotiation, and also I would say a lot of dialogue is also happening. I see that there are a lot of bodies where there is constant dialogue with the regulators is also happening.
It does seem to be a self-fulfilling prophecy that the technology advances, which causes more regulation, which then causes there to have to be more technology in order to comply with the regulation. So we do seem to be in a vicious circle.
Yeah, it's an arms race.
So Brian, what benefits and advancements do technologies such as AI and machine learning have on model risk management? And what do you see as the challenges and limitations on the implementation?
It's a fantastic question, because ultimately AI and machine learning are just tools. They're new tools in our tool belt. They're new technologies that allow us to solve problems in a more specific, granular way, in a more complete way, I would say. So I kind of split this up into two areas. First, what are the benefits, and then what are the challenges and things that we need to be aware of. Again, the key is they solve a fundamental problem. It's an underlying tool, just like an Excel page or a computer, right? These are technologies. In this case, it's cognitive technology. And what it's disrupted, and I like what was said earlier, that these are knowledge tasks. These are mundane, repeatable knowledge tasks. And those things can be automated much the way that manufacturing was automated by machines 50 years ago. It's the same sort of transition that we're seeing today. Factories in the 1910s had 100 people building a car. And if you look at a Tesla factory now, it's 100 machines building a car. And that kind of genesis is just starting with knowledge work. And it's a bit uncomfortable, admittedly, but it doesn't mean it's going to stop. We've seen a bit of existing regulation be applied to AI and machine learning. And although many regulations are being created or discussed now, things like model risk management from the European Central Bank, from the Fed here in the US, both have really standardized how they approach looking at algorithms, because they were traditionally used for things like capital ratios and financial reserves. In our discussions with these folks, they are starting to apply those to algorithms that use language, that are NLP based, that NLG, whatever the tech is. And it's the same sort of best practices and controls idea around how that works. That's of course on top of de novo regulation they're gonna put out. Flipping to the challenges and limitations, I really have three cautions, and these are as we've discovered in our journey. First is make sure that the models are expertly trained and expertly reviewed. There's a bit of a habit sometimes to hide domain expertise and not really use that in generating some of these models. And that's very, very risky because essentially it's like bringing someone in who has no background in reviewing a certain text or data and asking them for their advice. It creates risk, number one. Number two, as we talked about, follow the model risk management practices and protocols from the regulatory bodies. They do already exist. Was it SR 11-7 here in the States? And I forget the citation from the ECB. But these are really good ways to come up to speed and get started. And make sure you can prove it. Right? Make sure you can prove it to your folks. And if you're talking with a vendor, make sure that they can prove it to you. Right? That's really, really important to eliminate the risk of these new technologies. And the last one, I think this is the most important that isn't discussed a whole lot. We see in the B2C world where consumers are directly receiving some piece of information that models are trained using the community. They're trained using the clicks of the users. And that works great for, for things that face the general public. When you do that with applications across customers in, for an example, the financial services space, what you're actually doing is saying, hey, Bank A, you're taking on the risk of Bank B, because those clicks go back into the model, and then that model will recommend certain actions to Bank A. And that is a really, really significant risk that isn't really discussed until you dive into the way that this information set is delivered. So it's important that the models and the algorithms, AI, that is used actually sits behind the firewall, and not for every case, but for quite a few cases, if you want to target the firm, that it's for that firm rather than using someone else's data, because you're introducing contagion. And that's something to really look out for. And I know, Faye, there were some, you were going to jump off on that. We were talking a lot about the use of cognitive technologies.
Yeah, I think. Yeah,
be careful of the use of the word contagion right now. You know, that's
fair point. Fair point. Fair point.
Yeah. I won't repeat that word. I think when I think of, and this kind of applies just to implementations of technologies in general, not even really specific to model risk, but really applicable, is the word, and another bad word, accountability. The SMCR in the UK, individual accountability more broadly when we across the market, is that, and I'll get it wrong, so I won't pretend I'm going to quote the ICO, but the idea is that even if you delegate a responsibility, whether that delegation is to a member of your team, that delegation is to an engine of some sort, you're still responsible. So you can't just say, oh, the model did that. Oh, that's unfortunate that was the technology we used. The responsibility still sits with the senior manager or the individual who's accountable. So I think that's really important around when we think of implementing these technologies for model risk and broader, is that you still have to be able to explain how the model got to the number that it got to, or how the model got to the decision that it got to, who trained it, to Brian's point as well. How are you sure, and can you prove that you know exactly what's happening here? So it's great to deploy these technologies for many different things, but with all of these regimes, it's, do you know what's happening, and can you prove that you know what it is? And I think within SMCR, there's a line about delegation of responsibility as well, and delegation to any type of technology is also delegation. So we just need to be conscious that you are still accountable, that as much as we would like to blame the computers and blame the engines, that unfortunately, when the regulator is asking, it just isn't going to get you there.
So, I agree. You can't outsource that responsibility, right? I mean, there's no issue there. But don't you have the problem with any organisation with its hierarchy? Is, I doubt that senior people are sitting there in front of a very, very complex AI model, right? They're going to be wanting, the results coming from 2, 3, 4 layers down, and it being explained to them. So the knowledge of the AI model is deep within the organisation, almost at the junior end. Your graduates playing on their spreadsheets. Yeah. So don't you think there's a risk there that at some point, I mean, what I've found, I guess, in my roles over the years, at some point there becomes an intuition, and you see it in the credit world where intuition is used a lot. Do you think that could be lost in an AI kind of environment?
Yeah, it's a good point that it's even like when we think of not even just intuition, it's sentiment. It's all of the things that computers don't do well that you need to train. But I guess I'm trying to think back to even the start of your question I agree. There's all kinds of, like, back to, I think, was it Brian or Kaivalya that said that there's a new risk category every week, every month, that introducing of these technologies don't while they may reduce risk in one section and they may reduce certain elements of risk, they introduce a whole new set of risks. There's still elements of risk that need to be managed through, and again, they are coming through with whether it's the risk that you just don't identify a key piece. What I have actually seen within the GRC world is a little bit of governance around these models. And that's kind of people taking their set of models, identifying those, whether they're EUCs or they're actually automated models through more advanced engines, and taking those and trying to, on an annual or semi-annual or monthly basis, depending on the model, get assurance. So be aware, well, what are the risks with this model? What are the controls with this model that we have in place around here? And almost doing proactive assessments and just kind of RCSAs of certain models to get the governance and to be assured that, yeah, we got this. So yeah, I totally agree. They do bring risks. I think I have seen good things from the market around people trying to get governance into that kind of model risk governance and that side of how do we ensure that while all of this is great, that we still know where the buck stops.
Yeah, and I think that leads nicely to our to another question. I'm going to direct this at Jeff or at Kaivalya. How do you see collaborating with third-party vendors to add value for your institution or for financial institutions generally, without increasing the operational risk?
Yeah, I think outsourcing, if you see in the last decade or so, or maybe 20 years, it has significantly increased in the financial industry. And especially in the last couple of years, I would say the explosion in the fintech industry or the innovations that people are driving in terms of, especially on the customer side, it is going to be a fact of life. So it has to be co-opted. I don't think institutions can deny not to co-opt some of these innovations. Whether they have to figure out a way how do they adopt these innovations or how do they integrate into their process. And obviously outsourcing offers some certain obvious advantages because you have access to very skilled resources who are specialized, who are focusing on a particular problem or coming up with a solution, or they have got cross institutional knowledge also, because if, for example, if the consulting firms, they will have worked with various institutions, so they bring a lot of industry knowledge and the widespread knowledge to the institution. So these are the obvious value additions that the outsourcing solutions bring in. However, they also bring a lot of risks, and as Aoife earlier mentioned, there is a big question of accountability. Outsourcing cannot be seen as a kind of an insurance. Oh, I gave it to a particular vendor, so it's their responsibility. Because ultimately, the onus of the compliance or the regulation lies with the institutions. And I remember very clearly when we were implementing CORE back in 2013-14, the Basel CRD4 regulation. I had attended a seminar by PRA, and they were very clear about it that no matter what solution you deploy, whether you go to the vendor or you develop in-house, the onus of the compliance lies with the institution itself. If something goes wrong and your vendor can't fix it in time, you're still liable for it. So there has to be a kind of I would say, very strong governance and control around the vendor management, so that your operational risk can be optimized. The way I would see is that it has to be co-opted. I was using this word co-opted. That means you develop certain degree of in-house knowledge as well, while relying on a particular outsourcing or the vendor solution. You cannot, so I always use the term, there has to be collaboration between technology savvy risk officers or the business professionals and the business savvy technologists. There has to be a kind of a sweet spot between the combination of these two kind of the resources who can drive some of these solutions and address the challenge of implementing these complex technologies while still managing the operational risk that comes with any vendor and outsourcing solution.
And Jeff, do you have a similar perspective?
Sorry, I thought I'd lost connection there. So
no, you're there.
Thereby escaping the question. Well, first of all, completely agree. You can't and cannot outsource responsibility and accountability. And I think, as a senior person in a Brexit entity, if anyone's worked in a Brexit bank, it's all about outsourcing, right? So I'm, going through that whole framework. However, I think that the danger here is that with the speed of regulatory change, which is what we've talked about already, and just the other almost compliance-based activities, the look through into the into your outsourcing partner is becoming more and more almost intrusive. All right, so it's not about your outsourcing partner's capability, right? You can say they've got the brightest guys on the on the block, not a problem. But if they have issues with their tax affairs, all right, or employ subcontract another company based in Asia which uses whatever, all right, then you are ultimately responsible for a lot of the sins of your outsourcing vendor. So the risk, the operational risk, I think, is more than failure to deliver. It's inheriting the sins of your outsourcing partner. And I think that's what I guess would worry me. I'm lucky. All my outsourcing is really to my mother company in the UK. So for all of their good and bad, at least I'm only dealing with one entity. Significant outsourcing, all the way from your big IT vendor to the florist who brings the flowers in for reception. You inherit their sins. That's where the risk is, I think.
Yes, and I think over time we've seen, although a lot of focus is always on implementation of new technology, I think the ongoing relationship and ensuring when changes are happening in the technology is where we've certainly seen in the US, I know, a lot more enforcement actions because firms didn't know that technology changed or that other issues that modified the system that caused there to be some sort of compliance failure.
I think strong governance is very much important around all these relationships. Change governance, I would say. Yeah.
Okay, so we're down to the lightning round in our last 2 minutes. So everyone gets 30 seconds on what do you think? How do you think risk management will be impacted by RegTech and other technology solutions, say, over the next 5 to 10 years? I mean, that's only 30 seconds. So maybe everyone picks one thing that they think will change in the next 5 to 10 years. Brian, we'll start with you.
Sure. So I think if it's granular and targeted enough, it can actually reduce fines and reduce risk. So we can see the amount of monetary penalties come down over the next 5 to 10 years.
All right. Aoife?
Oh, I was going different on a different angle. I think for where I'm seeing it change even over the last 5 years and going forward, I think is kind of the convergence of risk and compliance really coming together. So people through GRC really happening, risk wanting to understand the regulations and want to understand why they must do some or comply with certain elements. I think going forward we will really see that kind of risk and compliance coming to the table together, and I hope it's a good trend, and I do hope it continues over the next number of years.
Jeff.
Yeah, I think I kind of like I'm going to steal probably Kaivalya's point, which is the integration of the systems. If that integration is done properly across your platforms, risk, compliance, finance, then I think taking out the complexity takes out the risk, and you can focus more on the identifying the risk.
Kaivalya?
Sorry,
Yeah.
Is Jeff stole your point?
I would add to that cross-LOB integration, a concept of last mile delivery, which is also becoming very important, because it's okay to have a lot of systems and the data that is integrated, but until it is deeper into the way the processes are automated around it, because a lot of times there's a lot of software applications, but people have a lot of manual processes to fiddle with the data or finally do the preparation. So the last mile delivery is also very important, along with all the integration of data and reporting platforms.
All right. I think that concludes our panel today. Thank you to all of our panelists. It was really fun and so interesting to hear everyone's differing perspectives. Thank you very much. Have a great day.
Thank you very much.
Have a great day.
Thank you.
Thank
Bye.
you. Bye.